Good morning. Good morning. Shall we start? Yes. Yes. So, listen. See, we are going to do this question number 3. This is a question which we normally don't try in class because this is business combination. This was TYK 13. Test your knowledge question number 13. Now added as now it is added as a practice question number 3. So this can be asked for exam. Normally we don't try this in class because the joint venture, joint operation adjustment is also there. When we are doing business combination, we have not studied IND AS 111. But now I feel you all have an idea about IND AS 111. What is IND AS 111? IND AS 111 is, what is the title? Joint arrangements. So let's read this question number 3. Very important. It can be asked for exam. Very important. Okay. Company X is engaged in the business of exploration and development of oil and glass blocks. Okay. Company X currently holds participating interest in below mentioned producing block as follows. Okay, I didn't understand. Company X is engaged in some business. Company X is holding participation interest in below mentioned producing block. Uh, Company X share is 30%, Y's share is 60%, Z's share is 10%, total 100%. Okay, fine. So far, I'm just reading this question number 3. I don't know what this is, whether joint arrangement is included or not. I have no idea. So I'm just reading. Company X is engaged in a business and it is also holding some participating interest. And these are the share percentage of X, Y, and Z. For the above block, company XYZ has entered into an unincorporated joint arrangement. So, I was asking you what is IND AS 111. IND AS 111 title is? IND AS 111 title is joint arrangement. As per IND AS 111, there are two types of joint arrangements. Joint arrangements are divided into two types. What are the two types of joint arrangements? One is JO, joint operation, and the second one is JV, joint venture. Joint operation and joint venture. How can I identify whether it is joint operation or joint venture? First point is incorporate. If you have a separate legal entity, if there is a separate legal entity you have formed, then it is a joint venture. If there is no separate legal entity, it is joint operation. So here it is given unincorporated joint arrangement. Unincorporated joint arrangement is joint operation. So you have not started a separate legal entity. Company Y is the operator of this block AWM/01. That is just a name. Company X and Z are the joint operators. So Y is operating and X and Z are joint operators. Company Y incurs all the expenditure on behalf of joint venture and raise cash call to company X and Z at each month end in respect of their share of expenditure incurred in joint venture. Okay, so which means one company is spending all the money and then it will raise a cash call. It will collect it from the other operators. Okay, fine. All the manpower and requisite facilities or machineries owned by joint venture are thereby owned by all the joint operators. Okay, fine. So rights over assets and obligations over liabilities. Rights and obligations are with the operators. So again, another criteria for identifying JO, JV. So this is JO. For past few months, due to liquidity issues, company Z defaulted in payment of cash call to operators. Okay, fine. Therefore, company Y, operator, has issued notice to company Z for withdrawal of their participating right on 1st April 2011. However, Company Z has filed the appeal with arbitrator on 30th April 2011. So what is happening here? There are three parties, X, Y, Z. And Z has defaulted in payment of cash call to operators, and company Y has issued a notice, obviously, and company Z has filed an appeal with arbitrator. Okay, understood. Now, financial performance of company Z did not improve in subsequent months, and therefore company Z decided to withdraw participating interest. So there is a conflict of interest between X, Y, and Z. So Z is withdrawing from this arrangement and entered into a sale agreement with X and Y. Sorry, entered into a sale agreement with X and Y. As per the terms of the agreement dated 31st May 2011, Company X will receive 33.33% share and Y will receive 66.76% share of PI rights owned by Company Z. So this is, so far it's a long paragraphs, long paragraphs. What are they trying to say? In one line, this entire page, we can sum up in one line. What is that? Company X and Y is buying the net assets which were owned by Z. Z is selling its participating interest. If it is a JO, joint operation, if it is a JO, three parties are having joint control. Three parties are having joint control, and Z's joint control is sold to X and Y. What is Z's share? Z's share in net assets was only 10%, or Z's share was only 10%, which is bought by X and Y. There is a ratio given, that is 33.1 by 3 is acquired by X and 2 by 3 is acquired by Y. Okay. Company X is required, 1:2 ratio. Yes. Company X is required to pay 1 lakh against 33.33% share. So effectively 10% into 1 by 3. 33.33%, even if they are saying Z's share is only 10%, of that 10% into 1 by 3 we are buying. After signing the sale agreement, operator Y approached Government of India for modification in production sharing contract, that is removal of company Z's name from PSC, that is production sharing contract, and government approved the transaction on 30th June 2011. Government approval for modification is essential given the industry in which joint operators operate. Are you focusing? Are you listening? What is given? So as I said again, it is just one line. Z is selling its share of business to X and Y in 1 by 3, 2 by 3, 1:2 ratio. And 31st May, they entered into an agreement, but government approval is essential. Government finally sanctioned it on or approved it on 30th June 2011. Okay, fine. Now they have given a balance sheet. Balance sheet of X and Z. PP company X balance sheet on 31st May and 30th June. Okay. Company Z's balance sheet is also given. PP, a long balance sheet is given. Okay, for 2 years. For 2 years, uh, not 2 years. It is 2 dates. Balance sheet as at 31st May and balance sheet as at 30th June of both companies are given. Okay, fine. Now additional information. Fair value of PPE and capital work in progress owned by Z as per market participant approach is 5 lakhs and 2 lakhs respectively. How much is the fair values of this PPE and capital work in progress is given? There is revaluation of this assets. Okay. Fair value of all other assets and liabilities acquired are assumed to be at their carrying values. Cash and cash equivalents of company Z are not to be acquired by company X as per the terms of agreement. Except cash, everything will be taken over. Cash will not be taken. Okay. Tax rate is 30%. As per IND AS 111, it is a joint operation whereby every operator records their share. Do you know what is the treatment as per IND AS 111 for joint operation? Only my share I'll be taking over. Yes or no? In the books, from the books of joint operation, only our share will be taking, only proportionate share will be taking over. You determine whether you need to determine the following: whether the above acquisition falls under business or asset acquisition as defined under business combination. What is the acquisition date? Past journal entries, draft balance sheet based on your analysis in part 1 above asset acquisition date. Okay. So these are the questions. So shall we at least some നമുക്ക് കുറച്ച് ചെയ്യണം. We need to try this. I hope you will try there in your notebook. I am also going to try. So here, now my question is this, or we are all trying. First point. Is this acquisition falls under business or asset acquisition? What, as per IND AS 103, there should be business. To apply the provisions of IND AS 103, there should be business. There should be business. What is business? Integrated set of assets and activities capable of being managed and conducted to generate profits from income from ordinary course of business. Or you should take our inputs process which is capable of generating output. So whether this is business combination. Again, one more line. To constitute as business combination, you should acquire control. In the given case, one joint operator's interest you acquired, which means control you acquired. So each party is having control. Yes or no? In case of a joint operation, each party is having control, and you acquired, the standard says you acquired control. One operator buying the share from another joint operator means you are acquiring control. So this falls under business combination accounting. This falls under business combination accounting. Okay, so first you should write the definition. Definition and control is acquired. Therefore, business combination accounting is to be done. Okay. Now, what is the acquisition date? Two dates are given. 31st May 2011, 30th June 2011. Two dates are given. So, which date is my date of acquisition? So, let me check what is given here. 31st May, we entered into an agreement. Agreement dated is 31st May, but government approval is required, is essential given the entity, given the industry in which joint operators operate. So it is substantive. So you should take 30th June 2011 as the acquisition date. Acquisition date is the date when control is obtained. As government approval is essential here, the acquisition date is 30th June. Okay. Now prepare journal entries for the above mentioned transaction. Okay. So what are the journal entries to be passed? What are the journal entries to be passed? So listen carefully. As I said, I'm writing first question number 3. If you have old study material, it is TYK question number 13. So what are the journal entries we are going to pass before journal, or we'll write the journal entries. I'll write the journal entry here itself. Listen. PPE debit. How much PPE debit? Company X, company Z, company Z's assets and liabilities is what we are acquiring. So you should debit PPE, but PPE is revalued. What is the revalued figure of PPE? Fair value of PPE is 5 lakhs. So how much you should take over? I'm not PPE debit how much? 5 lakhs is Z's share, of which you acquired 1 by 3. Yes or no? Can I take over entire 5 lakhs? No. We can debit only 1 by 3 proportionate share. So PP debit 1,66,667 brackets 66,667 gain. Why do I identify 66,667 gain? There is revaluation. See, if there was no revaluation, my share is only 3 lakhs into 1 by 3. But here it is 5 lakhs into 1 by 3. So 6667 gain, deferred tax liability. Deferred tax liability. Okay. Then ROU asset debit. So PP debit. ROU asset debit. There is no revaluation. So 20,000 into 1 by 3. 20,000 divided by 3. 6,667. Capital work in progress, there is revaluation. Capital work in progress, there is revaluation 2 lakhs. You revalued it to from 1 lakh 2 lakhs. So 2 lakhs into divide by 3. 66,667. So gain of how much is the gain? 1 lakh 1 by 3. 33. 333 gain. Loan receivable 50,000 divided by 3, 16,666 or 7. We are rounding off, so 16,667. Inventories debit 10,000. Trade receivables debit 33,333. There is no revaluation. Cash and cash equivalents, are we taking over? Do you remember what is given? Cash and cash equivalents, we are not taking over. Other current assets, 50,000 to 1 by 3, 16,667. 2. We cannot take over share capital. We cannot take over other equity. 2 lakhs. 2 provisions. Provision 66,667. Other liabilities 33,333. 2 trade payables 66,667. 2 anything else. So I debited one. I hope you're all writing the journal entry in your notebook or whatever rough book you have. You debited PPE debit, ROU asset debit, capital work in progress debit, loan debit, inventories debit, trade receivables debit, other current assets debit, 2 provisions, 2 other liabilities, 2 trade payables. Now what? 2 DTL. Very good. To DTL. How much is DTL? My share is 66,667 plus 33,333, 1 lakh. And what is the tax rate given? 30%. So it is 2 DTL. Very good. 2 DTL 30,000. No, not, yeah, 30,000. To detail 30,000. Should I take again 1 by 3 of that? Not required. Because 1 by 3 gain, I have identified 1 by 3. Accordingly, I have taken. Correct. 30,000. Anything else in my journal entry? Assets debit, liabilities credit. 2. Cash. To cash. I'll do 2 cash. 2 cash because my purchase consideration. 2 cash. To cash, then debits and credits I need to tally. 1,66,667 plus 6,667 plus 66,667 plus 16,667 plus minus 33,333 plus 30,000. So what is the balancing figure? You debited assets, you credited liabilities, to deferred tax liability, to cash purchase consideration. So we are literally comparing PC with the net assets taken over. So it is resulting in goodwill or bargain purchase gain. Bargain purchase gain of bargain purchase gain, bargain purchase gain, 2 bargain purchase gain. This is an OCI item and bargain purchase gain of how much you're all getting? Parele. 20,001. Must be correct because there can be. I am not saying the figure because we all have rounded off. Maybe 66, 66 angle the different could, the amount could be different. So here, yes. Okay, bargain purchase gain of 20,001. So this is my first. So this is business combination. Business combination accounting will be applicable. Acquisition date, journal entries. Now what is the requirement? Balance sheet. We need to prepare the balance sheet. So how to prepare the balance sheet again? See, as I said, the question is very lengthy. But this is very easy, right? How to prepare the balance sheet now? Balance sheet, they have already given the balance sheet of X and Z. So X, we will not take 31st May details. So PP, it was 10 lakhs and what we have taken over is 1 lakh 66,667. So the balance sheet total will, balance sheet PP will be 11 lakh 66,667. Just we need to add up quickly without wasting time. ROU asset 2 lakh plus 6,667. 1 lakh plus 66,667. Loan receivable 50,000 plus 66,667. Inventories 2 lakh 10,000. Trade receivables 33 3 lakh 33,333. Cash, there won't be a change. Cash, but there is a change in cash. What is the change in cash? There is one change in cash. We are not taking over PC. So you're all very good. PC, payment of PC. Correct, 1 lakh is to be deducted. Payment of PC. Now, other current assets, 2 lakh 25 plus other current assets I need to add, sorry, 2 lakh 25 lakh, 50 plus 16,000, 66,660. Asset side is done. So what is the total? 25 lakh 16,000. 25 lakh 16,668, 667. Okay. So how much should I take? 10. 668. Okay. And on the liability side, 25 lakh 16,668. Very good that you're all trying. Share capital 3 lakhs. This. We will never take over the other equity of share capital at the time of business combination. So it is again 3 lakhs. But don't forget to present what? Bargain purchase gain in OCI to be added. Yes or no? Bargain purchase gain in OCI is to be taken. That is 20,001. Okay. The NCIA, there is no NCI here. Provisions. Non-current liability provision 8 lakh 66 667. Other liabilities 3 lakhs plus 1 3 lakh 33 333. I know I should take over. There is a deferred tax liability to be presented. DTL to be presented. How much is the DTL? DTL to be presented is um, 30,000.
30,000.
30,000. Okay, thank you. And trade payables, we need to show trade payables 66, 667, 6 lakh, 66, 667. I think that's done. So 25 lakh, 16, 668. I think this is very easy. This is easy only after doing that JO, IND AS 111, after doing IND AS 111 combined with 103. This is very basic, but the question is almost 3 pages. The question is almost 3 pages. If we are not trying this, we feel something else is there. ഭയങ്കര complicated ആണെന്നൊക്കെ നമുക്ക് തോന്നും. But there is no complication. Easy question. Okay, have you all done? So I just wanted to ensure that you are all trying to feel that it is easy. നമ്മൾ വെറുതെ പറഞ്ഞു പോയാൽ നിങ്ങൾക്ക് ഇങ്ങനെ ഒരു ഈസിനെസ് തോന്നില്ല. Okay. Yes. So as I said, our business combination is long due. So our question ചോദിച്ചാൽ മതിയായിരുന്നു. They should ask this question. Okay. Now this is done. What is next? Question number 4, just pre-combination expense calculation that we are not doing. Question number 5, practice questions in the question number 5. 1 second. Practice questions, question number 5. ഇനിയല്ല new questions added ആണ്. We are going to try the new questions added. Please focus. Yes. Question number 5. Easy questions, but we should try once. Bima Limited acquired 65% of shares on 1st June 2011. Bima Limited acquired 65% of shares. Enough. Business combination. Control is acquired on 1st June 2011 in NAFA Limited, which is engaged in the production of components of machinery. Okay, one company acquired another company. NAFA Limited has 1 lakh equity shares of rupees 10 each. The quoted market price of shares of NAFA is 12 on the date of acquisition. So you're acquiring 65% shares of NAFA Limited. NAFA had 1 lakh shares. NAFA's market price is 12, which means what is the fair value of business of NAFA? 12 lakhs. 1 lakh into 12 is their fair value of business. Fair value of NAFA's identifiable assets as on 1st June is 80 lakhs. Okay. Bima Limited wired 50 lakhs in cash and issued 50,000 equity shares as purchase consideration on the date of acquisition. Okay. The quoted market price of shares of Bima on the date of issue is 25. So what they have given as purchase consideration? Purchase consideration they have given us cash. Then equity shares. How much is the equity shares they have given? Cash 50 lakhs and equity shares 50,000 into 25. Okay, 12 lakh 50,000. Bima also agreed to pay additional consideration of 15 lakhs if the cumulative profits earned by NAFA exceeds 1 crore. Oh, this is that additional consideration only if the profits exceeds by 1 crore. This is contingent consideration. Okay. On the date of acquisition, NAFA Limited assessed and determined that it is considered probable that an extra consideration will be paid. Fair value of contingent consideration is 9,80,000. Okay, fine. NAFA Limited incurred 1,50,000 in relation to acquisition. What is the entry? You all know that, but still, what is the entry? P&L to cash. Reduce from P&L, reduce from cash balance. It measures NCI at fair value. Oh, that is why they have given fair value of net assets or market price per share. Yes or no? Yes. How will the acquisition be accounted by Bima Limited under 103? Prepare detailed workings and pass necessary journal entry. Even though it is a new question added, it has no, it does not thrill us because already we have tried questions like this. Yes or no? What is my first step? Quickly, I'm just calculating what is purchase consideration. Purchase consideration is cash 50 lakhs. Okay. Share capital, shares, fair value of shares issued is, we already said 12 lakh 50,000. Then contingent consideration fair value is 9 lakh 80,000. So 50 lakhs plus 12 lakh 50,000 plus 9 lakh 80,000. 72 lakh 30,000 is PC. Then how much is NCI? NCI, we acquired 65% and they have 1 lakh shares. So 35% or 35,000 into 12 is NCI. 4 lakh 20,000. Yes, 4 lakh 20,000 is NCI. So purchase consideration plus NCI 76 lakh 50,000. And how much is fair value of net assets? 80,000. Sorry, 80 lakhs. 80 lakhs. So resulting in a bargain purchase gain or capital reserve. Can I write bargain purchase gain or capital reserve? It's okay, but 103 you write it as bargain purchase gain. How much is study material in many questions? I think in this question also they've written capital reserve. It is okay, but for exam you write it as bargain purchase gain. So 3,50,000. So what is the journal entry? Easy. Net assets debit 80 lakhs. To share capital. Share capital number of shares 50,000 into 10 share capital. 50,000 into 15 securities premium. To contingent consideration payable. To cash. Then to NCI. To bargain purchase gain. Yes or no? PPG bargain purchase gain. Yes. As I said, just because it is a new question I read, otherwise nothing great. EC എന്താ EC EASY ന് വരാണ് EC എന്ന് എഴുതിയേക്കുന്നത്. Okay, ആയിരിക്കും. So yes, question number 6. Question number 6. Okay, question number 6. 6, 7, 8, 9. 6, 7, 8, 9, 10. 6, 7, 8, 9, 10. 7, 8, 9, 10. Of which 10 is the kind of question which we tried yesterday. We can ignore. Let's see that. Entity A acquires entity B. Entity A agrees with the former shareholders of entity B to pay 900 with an additional payment of 500 if subsequent earnings of B reaches a specified target in 3 years. So you will pay PC 900, you will pay PC extra 500 if a target is achieved. So that is contingent consideration. The former shareholders also become employees. On the acquisition date, the fair value of net assets is 850 and the fair value of additional payment is estimated to be 200. At the acquisition date, the outflow of additional payment is not probable. Even if it is not probable, you should measure it at fair value. Over the next 3 years, the cumulative earnings of B, before considering the effects of additional payment amounting to 1,050. So what was the specified target? Only they have mentioned specified target. So it is 1,050 is the cumulative earnings. At the end of year 3, entity pays 500 as the conditions were met. State the impact on the financial positions and results of classifying the payment as remuneration and contingent consideration. What is this? I didn't understand this. State, I'm not reading the question again. State the impact on balance sheet, financial position, and results of classifying the payment. What if the additional payment is treated as remuneration? What if the additional payment is treated as contingent consideration? What is the impact? That is, you are paying contingent consideration. The former shareholders also become employees. So if it is not a part of PC, what is the impact? If it is PC, what is the impact? If we need to give two columns. If contingent consideration is remuneration. If contingent consideration is forming part of PC. Purchase consideration. If it is remuneration, purchase consideration is only 900. Yes or no? If it is part of PC, then I'll take 900 plus 5 alla 900 plus 200. Now we'll compare it with net assets. So the impact in bargain purchase gain. So I'll show the answer rather than me just explaining. We need not try but should see. And tomorrow if this is the question comes, you should be familiar. Question number 6. 6. Sorry. Yeah. The impact on financial position and results of classifying the payment as remuneration, contingent consideration, additional payment classified as remuneration, additional payment classified as contingent consideration. So remuneration, then PZ is only 900. Contingent consideration, PZ is more. Net assets remain the same. As a result, of course, goodwill will be, PC is more means goodwill will be more by 200. Here PC is more by 200. Then goodwill is more by 200. Then cumulative earnings, impact of additional payment. That is, this is the only area which I want you to focus. If it is a remuneration, 3 years condition satisfied. This is cumulative earnings, 3 years earnings. If it is expense, entire expense will be recognized and balance profits will be only 550. Yes or no? 1050 minus 500, 550. If it was contingent consideration, have you studied anything related to contingent consideration? If contingent consideration is treated as liability, if contingent consideration is treated as liability, not unwinding. Unwinding is for deferred consideration. Unwinding is for deferred consideration. Contingent consideration, every reporting date you should determine the fair value and gain or loss to P&L. So here initially you are recording contingent consideration payable 200. After 3 years conditions are satisfied, so contingent consideration payable becomes 500. Additional 300 should be recognized as expense. It should be charged to P&L. So 1050 minus 300. So if it is treated as purchase consideration, 750 will be your profits. If it is treated as remuneration, 550 will be your profits. This is the impact in P&L. What is the impact in balance sheet? Impact in balance sheet, treated as remuneration, 50 is goodwill. Treated as this, 250 will be goodwill. Here, loss is more by 200 and profit, വേണ്ട മതി. You got it, no? Any further explanation വേണ്ടല്ലോ. Is it okay? Or do I need to explain? Yeah, clear. You just need, as I said, this is easy, but you need to see this question once so that you won't make a mistake. Okay, 6, 7. Question number 7. Question number 7. Practice question number 7. We could have skipped this question if it was not a new one. On 1st October, IHL acquired 75% of Very Relevant Limited. Oh, one company acquired another company. Acquiree's name is Very Relevant Limited by paying cash consideration of 0.8 million. The fair value of NCI on the date of acquisition is 0.2. The value of Very Relevant Limited's identifiable net assets is 1.1. With respect to acquisition of Very Relevant Limited, determine the value of gain on bargain purchase when NCI is measured as per. Oh, so basic, alle. Purchase consideration is 0.8, 0.8. NCI, if it is at fair value, it is 0.2. If NCI is at proportionate net assets, 1.1 into 25%, 0.275. So it is 1 and 1.075. Net assets is 1.1, 1.1. So if it is the proportionate net assets. So 1 point more. So here bargain purchase gain is 0.1. Here bargain purchase gain is 0.025. As I said, we could have ignored this question if it was not a new one. Otherwise, you will feel something new is there, but she didn't touch it. Okay. Question number 8. Question number 8 is also, we are finishing it like this. An entity acquired 2 trade secret recipes. So this was an RTP question. Entity acquired 2 trade secret recipes in a business combination. Recipe A is patented. Recipe B is not legally protected. How the acquisition of A and B would be accounted for the entity as per relevant IND AS? What do you think? There are 2 recipes we are taking over. Okay, recipes. Recipe. So, can recipe be recognized as an asset in the books? Secret recipes, where maybe you have copyrights. So, acquirees, secret recipes taken over, intangible asset. It should be taken over and recognized as intangible asset. But recipe B is not legally protected. If it is what the answer they have given is, if recipe A and B are separable. Intangible assets. Intangible assets are identifiable non-monetary assets. Identifiable non-monetary assets without physical substance. Acquirees intangible assets can be taken over and recognized as it as separate intangible assets. I think again, അതിലൊരു doubt വേണ്ട. I'm just quickly, I think, yeah, I'll read the answer. Question number 7. 6, 7, 8. So first they have written the definition of para 11 and 12 of IND AS 38. IND AS 38 states that definition of intangible asset requires an intangible asset to be identifiable to distinguish it from goodwill. Goodwill recognized in the business combinations and asset representing. Okay. Asset is identifiable when it is separable. Okay. Asset definitions are given. In the given case, recipe A meets the contractual legal criteria for identification as an intangible asset. A is a separate asset because it is protected by a patent. This recipe is identified as recognized separately from goodwill while accounting the business combination. You should account recipe A separately from goodwill because it is an intangible asset, separable asset. So it should be shown separately. Since recipe B is not protected by a patent, it does not meet the criteria for identification of an intangible asset. However, recipe B is identified as a separate intangible asset because it meets separability criteria. Such recipes can be and often are exchanged, licensed, or leased to others. Therefore, unpatented recipe B should be accounted as. So, which means take over both recipes and show it as separate intangible assets. You write the definition of intangible asset. IND AS 38, write the definition of intangible assets. It can be taken over. Acquirees intangible assets can be taken over and shown as separate intangible assets, separate from goodwill. Okay, so I don't think this can be asked as a separate question, but maybe in a one big question, these adjustments can be asked. Adjustments can be added. Okay. 9. Okay, another. മനസ്സിലായോ? That question number 8. There were two recipes. One is protected, the other one is not protected. So what is the treatment in case of business combination? Even if an intangible asset is not fully complete, also we'll be taking over. Yes or no? പഠിച്ചിട്ടുണ്ടോ അങ്ങനെ? Even if an asset is not fully in process, research also will be taken over. So whether protected or not, take over to our books at fair value and show it as separate intangible asset. Show it as separate intangible asset. Okay. So 9, 10. Let's quickly finish. 9 and 10. Question number 9. 9 is a big question. Okay. I think full set we need to try. Question number 9. Mini Limited is a manufacturing entity in textile industry. Mini Limited decides to reduce the cost of manufacturing by setting up its own power plant for their captive consumption. As per the market research, so Mini Limited is a company. As per the market research report, there was non-operational power plant in nearby area. Hence, it is decided to acquire the power plant, which was having a capacity of 80 metric watt along with all entire labor force. This power entity was owned by another entity called Max Limited. Mini Limited approached Max Limited for acquisition of its power plant. So Mini Limited acquired Max Limited. Okay, fine. Mini Limited will seek an independent valuation for determination of fair value of this power plant. Value of other non-current assets acquired and non-current financial liabilities assumed. Oh, but you are acquiring that power plant, other non-current assets and other financial liabilities. So which means, are you acquiring just power plant? No, you are acquiring power plant, other assets, other liabilities. Okay, fine. Consideration agreed between both parties is 51 million. Purchase consideration is 51 million. Both parties agreed to terms and entered into an agreement on 1st April 2011 with immediate effect. Okay. Due to unavoidable circumstances, valuation could not be completed by the time Max Limited finalizes its financial statements for the year ending 31st March 11. Due to unavoidable circumstances, valuation could not be completed. Okay. So if valuation is not completed, is there any aspect you remember? Any time period is given as per IND AS 103? What is that called as? Measurement period. 12 months time is given. Measurement period. Due to unavoidable circumstances, valuation could not be completed by the time Max Limited finalizes its financial statements for the year ending 31st March 11. Max Limited's annual financial statements records the fair value of this power plant is 46.9 million with useful life of 40 years. Okay, fine. Max Limited also has license to operate the power plant unrecorded in books. It has a fair value. Some license is also there. It is not recorded in the books, but it is to be taken as 5 million. Okay. Okay, fine. 6 months after acquisition. So here, other assets, other liabilities, Power plant valuation, license valuation, 6 months after the estimated fair value is 54.9. What could be the journal entry? Again, see, 46.9 was the value you already recorded. Okay, now the value is finalized as 54.9. Um, so power plant value is increased. So, as per IND AS 103, if the valuation is based on the facts and circumstances existing on the acquisition date, when we record increase the value of plant and machinery or power plant, corresponding credit should be given to retrospective accounting, corresponding credit should be given to goodwill. Corresponding credit should be given to very good goodwill. Or if it was already a gain, gain will increase. Yes or no? Upon takeover, if it was a loss, loss will reduce because asset value has increased. Or if it was a gain, gain would have increased. Okay, so generally we'll credit to goodwill. Okay, fine. Now, CFO of Mini Limited wants you to work upon the following aspects. Okay, okay, CFO, we are ready to do the calculations because we have studied 103. Determine whether transaction should be accounted as asset acquisition or business combination. So here, integrated set of assets and activities capable of being managed and conducted to generate income. It is business combination. Okay, fine. Calculate goodwill or bargain purchase. See, otherwise also you will not write it as, I hope you will not write it as, asset acquisition, because if it is just asset acquisition, will there be goodwill or bargain purchase gain? They are asking you to calculate goodwill or bargain purchase gain. So this is uh, business combination only. Then, yes. പക്ഷെ അതാണോ റീസൺ ഞങ്ങൾ എഴുതേണ്ടത്? This is business combination because requirement number 2 is asking for goodwill and bargain purchase gain. No, we'll write definition of business combination. When past necessary journal entries in the books of Mini Limited. Okay, that journal entry, assets debits to liability. If there is a liability given, that will be credited to purchase consideration, gain or loss. Determine whether any adjustment is required in case of valuation received subsequent to acquisition. If yes, pass necessary entries in the books of Mini Limited. So guys, what do you think? This is easy അല്ലേ ശരിക്കും ഈ question. Even if again it is given as a lengthy question, once you study business combination, this seems to be what are the journal entries, what is the balance sheet, what are the entries to be passed, how to calculate goodwill, bargain purchase gain. If the steps are clear, this is very easy. They have given the balance sheet of Mini. So, oh, balance sheet are they asking? Prepare balance sheet. Past journal entries, prepare balance sheet. Subsequently, will there be any change? Okay. Okay. So, what do you think? Do we need to do this or discuss this question? So, if I am trying this, if this is the exam question asked this time, see, as I said, we should try the questions, practice the questions, and business combination will be asked this time. So, they have added new questions means from this they can ask. So if I start, this is business combination. What are the steps to be done? We'll do starts with acquirer. Who is the acquirer here? Mini. Okay, acquisition date. Here first both parties entered into agreement with immediate effect. So what is the acquisition date? 1st April 2011. Now step number 3, purchase consideration. Do I need to calculate purchase consideration? It is straight away given as 51 million. Yes or no? Purchase consideration is given as 51 million. Okay, so step 1, acquirer, acquisition date, purchase consideration. 4. What is step number 4? Net identifiable assets. Net identifiable assets. There is no tax rate. Otherwise, also fair value, book values are not given. So here, net identifiable assets, 11.1 non-current assets, 32 minus 32 liabilities, 46.9 fair value of the power plant, and license 5 million. So 11.1 plus 46.9 plus 5 minus 32. How much is the net identifiable assets? 31. Net identifiable assets 31. So purchase consideration is 51. There is no NCI here. Net assets is 31. So resulting in a goodwill or bargain purchase gain. It is resulting in a goodwill of 21. Goodwill. It is resulting in a goodwill of 21. Resulting in a goodwill of 21. What is next? Goodwill. So step 1, 2, 3, 4, 5. There is no NCI. Net identifiable assets, goodwill calculated. There is no NCI. Then what is my next step? Next step is balance sheet. Yes or no? Okay. Journal entries if I do. What are the journal entries to be passed? This is power plant debit. Power plant. We will debit at 46.9. Non-current assets debit 11.1. License debit 5. I know goodwill debit 20. To non-current liabilities 32. To purchase consideration. We assume it is cash. Is it given cash? Cash 51. Okay. Yeah. Now balance sheet. Balance sheet. I think I'm not preparing the balance sheet. Why we are not preparing the balance sheet? Okay, we are not preparing the, or I'll just, here this will increase by 46.9. No change. No change. Other non-current assets will increase by 11.1. Goodwill. We need to record goodwill. 20. License also. Intangible assets. License. We show intangible assets acquired. That is 5. Yeah. No. Asset side has not completed. Inventories, no change. Investments, trade receivables, cash and cash equivalents, minus 51. Equity share capital, no change. Equity component, reserves and surplus, no change. There is a non-current liability which we acquired, 32. So let me find what is the balance sheet total. 2158 plus 46.9. 2204.9. This is 2204.9. Capital work in progress 12. There is goodwill and license. Deferred tax asset no change. Other non-current assets 36.1. 4131. And there is, oh, here.
Total assets.
Yeah, total assets. 4131. Yeah, could be correct. It's 368. Oh, sorry. 368. 45 no change. Trade receivables no change. This is 110 minus 51. It is 59, 20, 267, 4131. Okay. 4131. And on my liability side, there is only one change. What is the only one change in my liability side? 32 non-current liabilities increased. So it is 4099 plus 32. Is it 4131? Yeah, balance sheet is tallied. Yes. Okay. I hope that is okay. Hmm? So this question can be asked. Question number 10. Question number 10 we can ignore. Why? Associate becoming subsidiary. Question number 10, they have added one more question on associate becoming subsidiary, but we are okay with that. Associate becoming subsidiary. On 1st April 11, Pride Limited acquired 30% shares of Famous for 4,000 crores. So 30% means it was IND AS 28. Net assets, share of profits, share of OCA, share of revaluation reserve. We did a question like this yesterday. Yes or no? Associate becoming subsidiary. Same thing. Next day you acquired balance 70% and everything is given. What is the acquisition date? Acquisition date, it's date when control is acquired. Determine the gain on previously held interest in Pride Limited. Determine gain on previously held interest in Pride Limited. Previously held interest. Already my investment was appearing in my books at 4425 and 30% of that fair value is now 4500. So what is the gain of my 30% share? 75 is the gain. How much is goodwill? Goodwill purchase consideration is 12,500 plus fair value of previously held interest. So it is 17,000. Net assets, there is no NCA. Net assets taken over is 15,000. So goodwill is 2,000. Past necessary journal entries. Past necessary journal entry. You know the journal entry. Yesterday we have done. Net assets debit, or I'm writing. Net assets debit 15,000. Goodwill debit. How much is goodwill? 2,000. To cash PC 12,500. To investment 4,425. To P&L 75. Then I should not forget one entry. Then I should not forget exchange difference in OCI should be reclassified to. Exchange difference in OCI will be reclassified to statement. Exchange difference will be reclassified to P&L. Exchange difference will be reclassified to statement of P&L. Revaluation reserve will be reclassified to retained earnings. So I'll do the reclassification journal entries. Easy. So there were 6 questions newly added, but all the 6 questions I personally feel it is manageable. Okay. This is practice question 1 and all. We have already tried in class, or you would have tried this two times exam question. November 19 we got this for 8 marks and July 21 or something we got it for 5 marks. This question okay ano? Should I read? This is your TYK question. Here what we are telling is we should take, they are telling we acquired 100% shares of a company, purchase consideration is 35 crores, net assets acquired is 15. So net assets does not include an established successful intermediate drug, but clinical trials are not received. There is an asset, but clinical trials are not are awaited. So I don't know whether it will be successful or not. Can I take over an asset uh, that has a life of 8 years? This is from this we can obtain a patent, but clinical trials are awaited. If it is successful, 15 crores. Now the value is 10 crores. So what do you think? Can you take over that patent? Yes, yes, it can be taken over. Intangible asset, in process research asset, even if clinical trials are waited, technical feasibility is not achieved, it can be taken over. Then you developed and patented a new drug and its cost is 12 crores and market value is 20 crores. It should be taken over at 20 crores. This should be taken over at 10 crores. And here there is a government license, 10 crores, which is not taken over. It also should be taken over. KK Limited has requested you to suggest the accounting treatment. So we'll say all these are to be all these items should be taken over, even if it is if even though an asset is not completely ready or completed situation complete either ready to use, even if the asset is not ready to use condition, yes, even if it is under process, acquirer's asset should be taken over at fair value in consolidated balance sheet. Okay, even contingent liability will be taken over. So are you okay? And that is question number 1. Question number 2. Question number 2 was this that lengthy question in uh, lengthy question in the test your knowledge. TYK question number 12. ഇത് നോക്കണോ വേണ്ടല്ലോ. This is very similar to what we have done. No, just we need to calculate purchase considering. All the steps are to be done, but we can ignore. There is no need to prepare balance sheet. അയ്യോ ഒരു question line missed out an area. In that mini limited problem, we already discussed, but still, in that mini limited problem, whether any adjustment is required in case valuation received subsequent to acquisition, there was 46.9 is what we recorded here. 46.9 we already recorded, but finally value has become 54.9. Is there a journal entry required to be passed? After 6 months, we obtained the new value. Journal entry required to be passed. Yes. PP value has increased by 54.9 minus 46.9. PP value has increased by 8. So the journal entry is PP 8 to goodwill. Subsequently, goodwill will reduce. And also in the answer they have done journal entry for depreciation. Because the asset value has increased, this asset is having a useful life of 8 divided by 40. There is an additional depreciation for 6 months, 0.1. Additional depreciation for 6 months, 0.1. 8 divided by 40 years into 6 by 12, they pass the entry depreciation. 6 months to PPE or provision for depreciation. 0.1. So that's it. See, because of that adjustment, actually I need to pass only this journal entry. Okay. Okay. This is my retrospective accounting. Retrospective journal entry is PPE to goodwill. PPE to goodwill madi. But here useful life is given 40 years. So they are like that remaining we need to pass retrospective accounting I am doing. This is existing from the date of acquisition എന്നുള്ള പോലെയല്ലേ retrospective. Yes or no? Retrospective. It is existing from the date of acquisition. Retrospectively, I am correcting PP. So as on 30th September, the asset value should be BC ചെയ്യണം. As part of business combination ചെയ്യണമെന്ന്. So anyway, as part of business combination, this is the entry. But because it is retrospectively 30th September, you should retrospectively means 6 months before I'm going back and adding. So as per IND AS 103, this is the journal entry. Then this journal entry, because it is retrospective accounting, asset value has increased. So we are charging an extra depreciation of 0.1. That is not as per 103. Not as per 103. Retrospectively, I don't 6 months. Okay. So that's it. So anything else, any area from business combination we need to discuss? You might have gone through yesterday. So is there any area to be discussed? Additional adjustments? Additional areas do we need to go through? So this is basically for you. So anything else we need to discuss? Like these additional areas are there. So if I quickly run through, goodwill can be two types. Two types of goodwill: full goodwill, partial goodwill. There are two types of goodwill. One is full goodwill, the other one is partial goodwill. Full goodwill is when we calculate NCI, we determine NCI at when NCI is at fair value. Here partial goodwill when NCI is at proportionate net assets. So if NCI is measured at fair value, we call it as full goodwill. Goodwill will be more. And if NCI is at proportionate net assets, it is partial goodwill. Okay. So in consolidation, we'll see impairment of full goodwill, impairment of partial goodwill. What are the adjustments? Okay, in consolidation, our next area, we'll find that. Measurement period. Yes, I remember. That is, IND AS 103 has given a measurement period, a window period of 12 months from the date of acquisition. 12 months from the date of acquisition. 12 months from the date of acquisition to finalize. 12 months from the date of acquisition to finalize the provisional fair values. To finalize the provisional fair values, IND AS 103 has given me 12 months window period. So what is given in measurement period? What they are telling? If the fair values are measured using the facts and circumstances existing on or before the date of acquisition. Okay, in 12 months you finalize the fair value if it is based on the facts and circumstances existing on the date of acquisition, retrospective accounting. Or if date of acquisition is 1st January 2025. After 1st January, there were some new developments. Based on the new developments, you determine the fair value. Then, if fair value is measured using facts and circumstances existing after the date of acquisition, account prospectively. Because facts and circumstances after the date of acquisition, you need to account prospectively. Okay. So, if net assets increase, within window period, if net assets increase, what will be the journal entry? Net assets 100 rupees increased means net assets debit to goodwill. If NCI is measured at proportionate net assets, the credit will be also given to NCI. Net assets to goodwill. But if NCI is measured at Proportionate net assets, if proportionate net assets retrospectively increase means proportionately NCI effect also should be given. Okay, fine. So, goodwill, what is the treatment? Goodwill, full goodwill, partial goodwill. There are two types of goodwill. Measurement period accounting. Then treatment of contingent liability of acquiree. What is the treatment of contingent liability? Contingent liability of acquiree should be taken over. Contingent liability of acquiree. Contingent liability of acquiree should be taken over. At what value contingent liability should be taken over at? Fair value. And if there is an indemnification asset attached to it. When you're taking over the contingent liability, if there is an indemnification asset given by the acquiree's shareholders, indemnification asset is also taken over provided asset value should not exceed asset value should not exceed the value of contingent liability. ഇങ്ങനെ വരരുത്. Which means asset value should be always less or equal to contingent liability. Yes or no? Indemnification asset value should not exceed beyond the value of contingent liability. അങ്ങനെയുണ്ടോ? പഠിച്ചിട്ടുണ്ടോ? Yes, yes, yes. In-house or in-process research of acquiring. In-process assets, in-house research items are to be taken over at fair value. It should be taken over at fair value. Okay. Contingent consideration. Contingent consideration, purchase consideration, which is contingent, can be treated as equity, can be treated as liability. What if it is equity? When do you treat it as equity? When do you treat contingent consideration as equity? Contingent consideration is expected to be settled in the form of fixed number of shares. Fixed number of shares. If it is expected to be settled in the form of fixed number of shares, such contingent consideration will not be restated or remeasured. It will not be remeasured. It will not be remeasured. If lapsed, if that contingent consideration is not payable finally, so then lapse should be transferred to retained earnings. Always liability to retained earnings. Equity components reclassification is to liability to P&L. Sorry, liability to P&L. Equity components reclassification is always towards retained earnings. Retained earnings. Then if contingent liability is in the form of liability, not in the form of fixed number of shares, if not in the form of fixed number of shares, subsequently it should be measured at fair value, gain or loss to statement of P&L. Okay. Now, treatment of non-replacement award. What is non-replacement award? Acquiree company was having a share-based payment reserve, share-based payment plan, which is replaced by acquirer. Then what is the treatment? If it is replaced by acquirer, what is the treatment? So acquirer will be bearing the expense. Acquirer's expense will be divided into two. Pre-combination, post-combination. Pre-combination will be treated as PC. Post-combination will be recognized as expense over the remaining vesting period. Okay. What if it is not replaced? So the standard says if it is not replaced also, acquirer can make some changes to the terms. Acquirer can modify the share-based payment plan. So anyway, if it is non-replaced, find out the pre-combination expense. How do I calculate pre-combination expense? Treatment of non-replacement award, pre-combination expense will be allocated to pre-combination expense should be recognized as NCI. Pre-combination expense will be recognized as NCI. Pre-combination expense will be recognized as NCI. Okay. So pre-combination expense, same formula. What same formula? Fair value of original award into vesting period completed. Divide by original vesting period or revised vesting period. If there is a modification, that revised vesting period. So modification, if it increases vesting period, it will be ignored. Modification, if it is reduces vesting period, which will be considered. Okay. As per 102. So that's it. And finally, our area is reacquired rights. Reacquired rights. Reacquired rights. Last area to be in the additionals. What is reacquired right? One second. What is the treatment of reacquired rights? So reacquired rights should be always taken over at reacquired rights. Always will be taken over by the acquirer at fair value. It will be always taken over at fair value. What is reacquired rights? Say I have given you a right and I'm reacquiring it back from you. So you are the acquiree. In the books of acquiree, there is a license. In the books of acquiree, there is a license which acquirer has originally given. So this license will be taken back by acquirer. So it should be, when it is taken back by acquirer, what the standard says, purchase consideration should be divided. This purchase consideration is called as composite PC. Composite PC means PC includes something else because you are in a pre-existing relationship. So this has to be divided. If there was a contractual relationship, that is licensee relationship, PC is expected to include lower of what? If there is a contract between this acquirer and acquiree before, if you end that relationship, if end that license, if licensor relationship were to be ended, terminated, if that contract has to be terminated, what is the settlement value to be given? Already it will be mentioned. So if purchase consideration is 100 crores and there is reacquired right, which means there was a contractual relationship. Already it is mentioned in the contract that if the licensor or licensee cancels the agreement, 2 crore termination fees to be paid. This is agreed settlement value in the contract. 1. Then 2. Compare fair value and book value of asset. What is fair value and book value of asset? Fair value of the asset is now 8 crores. Book value of asset is only 3 crores. Which means I have given you the license at a value, but now I am taking over at a higher value. So there is a loss of 5 crore. So if that contract purchase consideration is 100 crores, if I were to terminate the contract other than in the course of business combination, I had to pay 2 crore. In the course of business combination, I have a loss of 5 crore. Are you understanding? Business combination കാരണം എനിക്ക് ഒരു 5 കോടിയുടെ loss ഉണ്ട്. I have a loss of 5 crore because of business combination. Because I have given you at 3 and I am taking over at 8. There is a loss of 5. If there was no business combination, my loss would be 2 crore to end the contract. So you take whichever is lower. 2. That is 100 crores include payment of the 2 crore also. Therefore, 98 crore will be considered as purchase consideration. 2 crore. So PC you will take 98 crore. Then settlement of or settlement of penalty you take 2 crore. To cash 100, of which 98 towards business combination, 2 towards settlement of that liability, termination penalty payment. Did you get this? Mm. Okay. Now, if it is non-contractual, there is no contractual relationship. Then PC includes fair value of settlement. If there is, so the example they have given is plaintiff-defendant relationship. So A limited, B limited. Now A is acquiring B, but A is acquiring B and paying purchase consideration 100 crores. But B has already given a case against A, claiming 5 crore damage. So, if there was no business combination, A should pay 5 crore. Yes. So, at the time of business combination, you pay 100 crore. The standard assumes 95 crores is towards business combination and 5 crores is towards settlement of that liability. If non-contractual, if it is contractual, I have to check A and B, whichever is lower. So these areas you need to be very careful. You can get a 4-5 marks questions, or it can even be asked in MCQs. Now the small areas can be also tested in MCQs, or this time we do expect a long answer question. We don't know, we are waiting. Okay, so as I said, is there any question from your side which I need to explain, or any area to be explained, or is it okay?